Hello, it's Chuck Carnevale, aka Mr. Valuation, co-founder of Fast Graphs, bringing you another 2-minute drill, lessons in valuation, subscriber request series. And I want to say something very importantly here. These are companies that I'm featuring here that subscribers have asked to see. These are not companies that I think are necessarily good investments. As I go through the video, I'll try to let you know what I think of the company. But one of them I've gotten several requests for is almost impossible to evaluate. And it's called SoFi, and it's a financial company. You can see all the different, they have personal loans, banking, credit scores, etc. So when I go into the company, I also have some other problems. If I do a max view of it, it had several years of losing money. And then from 23 to 24, it went from minus 4 cents a share to 39 cents a share. And this gives this aberrant growth rate here. And then earnings are expected to drop again in fiscal 2025, which we're currently in, obviously. We're through March. And then earnings expected to grow 112% and then 34%. Now, when I put weekly closing stock prices on the graph, all right, we get some really crazy looking pictures. First of all, I've got a growth rate here of 18.22%. So when I'm looking at the max time frame, I'm drawing the fair valuation line at 18.22. But if I drop this down to a 3-year graph, now I've got a 23% growth rate, and the PE ratio is being drawn at 23. As you adjust time frames, you're measuring different growth rates, different data. Fast Graph automatically adjusts for you. Okay, now if I go back to a 4-year graph, I've now got a 41% growth rate, and I've drawn that. If I'm using P equals growth rate, which is Peter Lynch's, this is what it would look like. But here's the problem. We're expecting down year of earnings this year. So you can see the stock prices reacting to that. Then we're expecting this huge increase the following year and after that. When I look at the forecasting graph, we're coming from losses to a huge growth, then a dropping earnings, and then expected to grow. So out here, this could be an interesting company if you're willing to buy it now, but there could be a lot of volatility in the short run. This is a difficult company to analyze, and I'd be very careful. It's going to require a lot of research and due diligence. Now, one area that you can obviously look at that I think is worth looking at would be price to sales with companies like this. How's it doing on a price to sales? I'm going to take that custom ratio off. And sales aren't expected to grow very much. It has been trading at around a 3 price to sales. I just don't know how to analyze this one, so you're on your own. But anyway, thanks for watching. If you liked the video, give me a like, ring the bell, subscribe to the channel, and subscribe to Fast Graphs. Thanks for watching.